Welcome back, everyone. This is Tom Vylord from Wall Street Value. Today we're going over Section 1, Intro to Investing into the Stock Market. And before we dive into this, just want to go over a couple disclaimers here. We are not your financial advisors. We're not here to give you specific investment advice. We don't know what your risk tolerances are. We don't know what your goals and objectives are. So we're not here to give you advice. The specific companies that we do talk about in this section, as well as the rest of the course, are to be taken as educational and illustrative purposes only. So now that we got that out of the way, let's get moving. So someone's sitting in the shade today because they planted a tree a long time ago. This is one of many awesome quotes by Warren Buffett. So here's what we're going to talk about in this section. Number one is investing right for you. Next, we're going to talk about risk tolerance. What are your investment objectives? And then we're going to talk about time horizon. What are your current investments? Some common investment mistakes and how to avoid them. And lastly, we're going to talk about goal setting. Is investing right for you? Investing in the stock market, especially if you've never done it before, can seem very exciting. You hear stories of how Warren Buffett made billions of dollars in the stock market, so you want to start on your own path to riches investing in stocks. It all sounds awesome until you experience your first loss. Do you have the stomach to handle the inevitable loss? Are you emotionally stable enough to invest in the market and stay in the market through all of its ups and downs? If the market has a drop right after you invest in it, and that's going to happen, are you going to react to that and sell every position you have, or are you going to hang in there and stay rational? These are very important questions you have to ask yourself before you put any of your hard-earned money into any stock. If the thought of losing a penny isn't right for you, you have a couple options. Number one, you can keep your money in the bank and don't invest in the market. It's probably not a good long-term solution because you're really not going to grow the assets very well. Next, you can start very small. Just put a little bit of money into the market. Next, you can learn to paper trade. Leaving your money in the bank may not be the best decision for the long-term well-being of your portfolio. Although it is safe, you're not growing your life savings. Since savings accounts and money market interest rates are currently very low, you could be losing purchasing power each and every year due to inflation. Therefore, leaving your money in the bank is not the best long-term solution. Next, you can start small. Some people are so intrigued that they do want to start testing out the waters immediately. If you are so intrigued to do so, but the volatility of the market makes you a little nervous, then put just a small amount into the stock market. Put no more than 5% of your liquid net worth into the stock market. Ideally, the best choice would be to paper trade. Paper trading is also known as simulated trading. You invest without trading real money. There are a lot of software programs available, such as Thinkorswim through TD Ameritrade, and it lets you set up a practice account, also known as a paper trade account. Practice? We talking about practice? Not a game. Not a game. We talking about practice. I'm a huge 76ers fan. This is one of my favorite players, and that was the best press conference of all time. If you don't know what I'm talking about, go Google Allen Iverson practice press conference. This allows you to practice trading and see what it's like to have an active investment that moves around without having to put real money into the trade. Allows you to practice entering and exiting a trade, going through real-life emotional decisions when a stock goes up and down, monitoring a trade, etc. And more importantly, it allows you to practice as you further your investing education. If you make mistakes, it's not going to hurt you financially. However, those mistakes will be learning experiences. And the idea is that while paper trading, you'll have made dumb mistakes of a new trader and a new investor, and once you start with real money, those same mistakes won't happen again. So success comes from learning, training, instruction, and of course, lots of practice. Next thing we want to talk about is risk tolerance. This is the amount of fluctuations an investor can withstand. An investor who has a high tolerance for risk can enjoy higher rates of return on their investments, but they're also going to experience larger swings in the price movements of those investments. An investor who has a lower risk tolerance will earn lower rates of return on their investments, but they're going to have very little swings in the movements of their investments. Investing in stocks involves a lot of potential rewards, but there are risks involved as well. If you want those higher rewards, you need to accept the higher risk, and conversely, if you want lower risk, you need to accept the lower rewards. You need to find a manageable level of risk that you're comfortable with. To help you find that proper level of risk, ask yourself a few of the following questions. How much can I afford to lose? Will I lose sleep over this investment? Will I be able to act rationally if the investment suddenly declines? Lastly, do I understand the investment? You should never invest more than you can afford to lose. If you're investing your mortgage payment in the hopes that that investment is going to double or triple in a short amount of time, then you are setting yourself up for disaster. That's gambling, not investing. If you're tossing and turning each night because you're afraid of what could happen to your investment, then you're taking on too much risk for your comfort level. Warren Buffett says investing properly should be boring. He also says it should be lazy and bordering on sloth. Investing properly includes having a risk tolerance that you're comfortable with. It's not boring, you're taking on too much risk. A proper amount of risk could allow you to go about your day without having any worries about the day to day fluctuations of the stock market. Emotions are the biggest killer to portfolio returns if they're not in check. Stocks are going to go up without reason, but they're also going to drop without reason. And many investors may overreact to a sudden drop and sell based on fear. Manageable level of risk will allow you to take a step back and make decisions rationally based on facts, not emotions. In this course, we're going to teach you how to remove emotions from your decision making. Once you're in an investment, you got to monitor the investment. This means you need to know about the business that you're investing in and what's going on, at least on a quarterly basis. This is very hard to do if you don't understand the business that you're investing in. And this is one of 4 things that Warren Buffett looks for in an investment. He's only going to invest in a company that he fully understands or is able to understand. If you're investing in a company because it's the hottest performer on Wall Street or because you got a hot stock tip from somebody, you're doomed to fail. You can really take out a lot of the unnecessary risk involved with investing by only investing in businesses that you fully understand. Each person has their own acceptable level of risk. You got to find out where your level is. Investing in the stock market has proven to be an excellent place to invest money over the long term. However, no matter how great it can be, you're not going to be disciplined to stick with it if you're not comfortable with it. So find your level of comfort and do not stray from your risk tolerance. Another very important thing to consider when you begin investing are your investment objectives. What's the purpose of investing? Are you looking for short-term gains? Are you looking for long-term growth? Are you looking for current income? Or maybe your objective is to have both growth and income. And based on what your investment objectives are, then you can determine your time horizon. Time horizon refers to the amount of time your money will be invested before you need it for your end goal. If you need money for a down payment for a home in the near future, your time horizon will be short term. Shorter term time horizons would require a more conservative investment plan. And the reason for this is simple. If you put the assets into a safe investment, such as a short term bank CD or even a money market account, that money's going to be there for you when you need it. If you put that money into a volatile stock, it may be worth a lot less when the time comes to withdraw the money for your end goal. However, if your time horizon is long term, such as planning for retirement that could be 10, 20, 30 years away, then that can allow you to take more risk and achieve a potentially higher rates of return. If retirement is several years away, the day-to-day fluctuations shouldn't matter that much. And on the flip side of that coin, if you invest in very low risk investments, like the bank CD we talked about in the previous example, the conservative returns on that investment may not grow your retirement nest egg enough to achieve your retirement goals. New investments should not be made without taking a look at your current positions. If you've already invested in several large company growth stocks, then adding another investment in that same category may not make a lot of sense. And this is especially true if you're underallocated into other asset classes. That's why you need to consider your entire portfolio before making any investment decisions. And your entire portfolio would be your retirement plans, such as the 401k or 403b plan that you have to work. It would also include any Roth IRAs, traditional IRAs, mutual fund accounts, stock trading accounts, bonds, annuities, and even accounts that you have set up through the bank. Investing in the stock market can be intimidating to a new investor. There are a lot of things to learn, and we're going to teach you what you need to know to become a very successful investor. And as we move forward, you should be aware of some of the very common investment mistakes. First one we've already talked about, and that's the hot stock tip. And here's what I have to say about investing in a hot stock tip. If you do so, you're going to have a bad time. Most of the time, it's a piece of crap. That hot tip is going to be a dog. And when you receive a hot tip, ask yourself a couple questions. Who's giving you that tip? How successful is their investment track record? Where did they get that tip? If it's public information, then why is it such a hot tip? And if it's not public information, then it's insider trading, which is illegal. And why are they giving you the tip? This leads to mistake number 2, swinging for the fence. Never swing for the fence, or as my mom used to say, don't put all of your eggs in one basket. Most new investors fall for the trap of the huge potential returns that a stock can make, especially if it's a hot stock tip. Rather than looking at the potential losses they can incur, it's much more fun to look at the triple digit returns that could be earned, but probably won't. Instead of allocating a proper 3 to 5% into this sure thing, they load up the truck. What's the fun investing in just 3 to 5%, especially if this is a home run? Why not put 50% or more into this fund? And then this is what happens. You put all your eggs in one basket and it didn't work out according to plan, and there goes your principal. Assume, for example, you lost 50%. Let's take a look at how long that's going to take to recoup that loss. You had $100,000, you put too much of that into the sure thing, and now it's worth just $50,000. If that stock recovered and went back up by 50%, you didn't recover your full $100,000. It's only back up to $75,000. In order to recover that 50% loss, the stock would need to increase by 100% just to break even. So you have $100,000, you cut it in half, it's $50,000. $50,000 multiplied by 50%, it's going to give you 75 grand, not 100,000. So you need to double that $50,000 just to make yourself whole. And how long is it going to take to make up that 100% rate of return? Well, if you take a look at the S&P 500 and just assume it's made a 10% rate of return over the long term. I believe it's been a little bit less than that, but let's just assume 10%. It's going to take you 10 years just to break even. If you had applied a suitable allocation, that collapse would have a minimal impact on your total portfolio. Mistake number 3, jumping on the bandwagon. This is another mistake we see rookies as well as experienced investors make all the time. Hopping onto a stock after it has a huge run-up. While stock can continue to soar, it's much more common for an overly valued stock to come back down in price. If you hop on right before that inevitable drop occurs, you're going to get bit in the butt. This is also known as chasing performance, which is selecting investments based on past strong performance. Later on in the course, we're going to teach you when to enter a position and when to exit a position, and this is going to be based on numbers and facts. You'll learn how to identify a great investment before it takes off, not months or years after that appreciation has occurred. Mistake number 4, thinking short term. It's rare that investment that you purchase starts to skyrocket the second you buy it. It just hardly ever happens. Investing requires a lot of patience. Don't get frustrated if you buy some shares and it's flat for quite some time, or even if it drops after you buy it. If you've done your proper research, which we're going to teach you, you just need to have some patience. Famous hedge fund manager, author of a couple of great books, and Columbia University professor, Joel Greenblatt, says that he's going to give his positions at least 2 years before he decides to cut ties with it. And mistake number 5, investing with emotions. Here's one of Warren Buffett's best quotes. Buy when others are fearful and sell when others are greedy. The reason why most investors suck at investing is because they invest using their emotions instead of sound facts. People buy when there's already greed in the streets and stock prices are at ultra inflated levels. And then they sell at the first sight of fear. This is what happens when emotions dictate your actions. Successful investors have a plan for when to get in and when to get out of positions, and we stick to that plan. We do not let the ups and downs of the market make decisions for us. There are a lot of other mistakes out there, but I'm going to give you one more, and that's having unrealistic expectations. From March 9, 2009 to where we are today in 2018, the market has had one of the best bull markets in history, and that could lead to some unrealistic expectations. Don't fall for the gimmicks that you see on late night infomercials or Instagram ads where people are claiming to easily earn triple-digit returns trading cryptocurrencies, options, penny stocks, etc. They're promoting the winners, but they're not telling you about the losers. If Warren Buffett, the greatest investor of all time, isn't achieving those absurd returns consistently, neither will you. As of 2018, the S&P 500 index has performed 8% over a 10-year time period. Over a 15-year time period, it was just 7.22%. Now, more recent years have been better, but over the long term, the S&P 500 index had a return of 7.22%. And this is according to Morningstar.com. We're going to show you how to enhance those returns using some basic strategies that investors like Warren Buffett and the top hedge fund managers use on a daily basis. Returns of 15%, 20%, or even a little bit more are realistic, but we're investing, we're not gambling. If you're getting into this with the goal of doubling or tripling your money with each investment, especially in a short amount of time, you're gambling, not investing. And gambling is a loser's game. Wealth is hardly an accident. It takes a lot of hard work, a lot of time, and dedication to hone your skills and to perfect your craft. It also takes a lot of education. This journey you are starting on is not a get-rich-quick scheme by any stretch of the imagination. If you think it is, then stop right here. Don't waste any more of your time. It is, however, a get-rich over the long-term strategy. It will happen if you set realistic goals and you apply the education that we're providing you to make it work. As an investor, you need to set your own personal goals. This is going to include what type of investment strategy you're going to adopt. Nobody has sustainable success investing in anything and everything. You need to determine what you're going to look for. You need to determine a strategy and stick to that strategy. You should have a goal for what rate of return you expect on each investment. You should have clearly defined parameters for getting into and out of an investment, and we're going to teach you this stuff. Have a goal for how long you intend to be in each investment. Are you going to be a short-term trader or are you going to be a long-term investor? You can also have a combination of both. As we said earlier, expectations must be realistic. Don't set a goal for turning $100,000 into $1 million over the next 4 months. Set a goal for how you plan to consistently learn and develop your skills. What books you're going to read, what other courses are you going to take, and what conferences will you attend to further your education. Also, keep a journal. When you make a mistake, journal it. What went wrong and what could have been avoided in the trade that you made? What will you do next time so you won't make the same mistake again? Don't get discouraged with mistakes or losses. It's all part of the game. Even the most successful investors have losses from time to time. Use these losses as learning experiences. And lastly, believe in yourself. You can do this. We are providing you with everything you need to be a successful investor, but we can't provide you with your own self-confidence. Thousands of students from all walks of life, educational backgrounds, ages, races have gone through this course and have found success investing in the market. They have used our process for finding good investments, stuck to the program, and applied what they've learned. There's absolutely no reason why you can't do the same. If you follow our program and consistently apply what we teach, you'll be on the same path to financial freedom as all of our graduated students. We want you to apply what we're teaching. At the end of each section, we're going to give you an activity to do that will help you apply what you've learned in each section. Your first learning activity: open a paper trade account so you can practice what we're going to be learning throughout the course. Pick any platform that interests you, but the one that I've found to be the easiest to use is Thinkorswim's platform through TD Ameritrade, and I gave you the link right here. And I'm also going to give you a second learning activity. Answer the questions in the risk tolerance section of this course and determine how much risk you're willing to take, and do that before you go on to the next section. That's it for today. I'll see you soon.